Hi, in this video we will be seeing a small case study of calculation of weighted average cost of capital. In the last videos we have seen what is cost of capital, what are the components of cost of capital. In the component we have seen cost of equity and cost of debt, and how these components are calculated to arrive at a weighted average cost of capital. In this video we will be working out the problem. Look at these slides. PQR Limited has the following capital structure on October 11, 2013. I think you know what is capital structure. Capital structure consists of the combination of debt plus equity. If you technically speaking, in simple term, what do you mean by capital structure? It is a specific mix of debt and equity that a company uses to finance its operations and growth. Debt consists of borrowed money that must be repaid, often with interest, while equity represents ownership stakes in the company. Normally the four types of capital structures may be there: equity share capital, debt, preference share capital, and vendor finance. PQR Limited has the following capital structure on October 11, 2013. This is a capital structure of a company. Equity share capital, in bracket 2 lakhs number of shares of rupees 10 each. So the value of equity share capital is 20 lakhs. Then the reserves and surplus also 20 lakhs. Then company issued 12% preference shares 10 lakhs worth rupees 10 lakhs. Then company issued 9% debentures for the worth of rupees 30 lakhs. The market price of equity share is rupees 30. It is expected that the company will pay next year a dividend of rupees 3 per share, which will grow at 7% forever. Assume 40% income tax rate. You are required to compute WACC using market value weight. Calculation of WACC. Existing capital structure. Cost of equity is D1 divided by PO plus G, that is 3 means the company will pay next year a dividend of rupees 3 per share. So dividend, D represent dividend in the numerator. So 3 by 30. The current market price of equity share is 30. So 3 divided by 30 plus G, growth. That means the dividend will grow at 7% forever. That means it is expected that the company will pay next year a dividend of rupees 3 per share, which will grow at 7% forever. So the growth rate is 7%. We'll substitute the formula, we'll get 17%. Cost of equity, a simple calculation method. 17% cost of equity. Then we'll move to cost of debt. Formula is interest expense, that is a rate of interest into 1 minus T. T means T represent tax rate. So formula is cost of debt is equal to rate of interest into 1 minus T. So What is the rate of interest? In the table column, 9% debentures the company issued for the worth rupees 30 lakhs. So the interest rate is 9%. So here the rate of interest is 9% into 1 minus T, tax rate. What is the tax rate? Marginal tax rate. Assume 40% income tax rate. So 0.4. Convert into numerical value. 40% divided by 100. So we'll get 0.4. So interest expenses 9% into 1 minus T, tax rate 40%, will get 5.4% or 0.054. So we are applying these components to arrive at weighted average cost of capital. Equity share capital worth rupees 60 lakhs. That means the amount, then 12% PSC, that is preference shares capital 10 lakhs, 9% debentures 30 lakhs. The company issues 2 lakhs number of shares of rupees 10 each. Then after tax cost, we have already found the after tax cost. For cost of equity it is 70%. So 17 divided by 100, 0.17, and preference share capital is 12%, 0.12, and 9% debenture, that is cost of debt 0.054. Then we are giving the weightage to the capital structure. Out of 100%, what is the proportionate of equity, debt and preference share capital? So 60% of capital which is occupied by the equity share, that is common shares, and 10% preference shares, 30% debt funds. So we multiply the after tax cost with weightage, will get the answer. For equity capital it is 0.102, for preference share capital it is 0.012, for debentures it is 0.0162. The weighted average is 0.1302. The weighted average cost of capital is 0.1302, or if you multiply it with 100 means we get the percentage. 13.02 is the weighted average cost of capital. Thank you.